Which actually builds more wealth? Buying property or investing in the stock market? Everyone has an opinion, but the numbers tell a surprising story.
Take this example, and let's keep it apples to apples and not reinvest any dividends. If you bought the average U.S. home in 1995 for about $153,500, by the end of 2024, it'd be worth roughly $557,000. Pretty solid growth, right?
Absolutely. Now compare that to the same 153K invested in the S&P 500 index. That investment would have grown to 1.43 million. That's not just growth, that's the power of compounding.
Today's episode is brought to you by Security Financial Management.
Welcome back to Best Advice Podcast, guys. I'm your host, Rob Lavalio, here with Senior Advisor at Security Financial Management and Daniel Corson. Dan, what's cracking, baby?
Oh, it's another beautiful day here in Orlando.
I missed you last week, man. We didn't do a pod together.
I know.
I was a little lonely.
We had a miss a week.
I realize that I miss you.
But good thing the hurricane never made landfall, right on by.
Yes, that's a big win for Florida.
But at least some people are prepared for the next one now.
Of course. Let's get straight to it with the question of the day. Today's question comes from Jason in Austin, Texas. Jason, what you got for us?
Hey guys, Jason here. I'm 30 years old and wondering what's more beneficial, using my savings to invest in a rental property or putting it all in the stock market.
Great question, Jason. So Gen Z swears by real estate while the baby boomers swear by stocks. But who's right? Dan, please break this down for us.
Here's how stocks work. You can start with a few $1,000s. Historically, the market has outperformed real estate over the long term. You get diversification and professional management through ETFs and mutual funds. And investing through accounts like a 401k or IRA means tax-deferred or even tax-free growth. But stocks are volatile, markets swing daily, and downturns can test your patience. We've seen that human behavior is the biggest detriment to performance. Rob, don't you have a real estate license?
I do.
So you probably know a thing
Let
or
me
two
be the
about.
insight guy on this time.
Okay. I'll let you talk about real estate.
We can change it up, baby. So on the flip side, here's how real estate works, right? You can use leverage. A small down payment can control a much bigger asset. Plus, mortgage interest up to $750,000 is tax deductible. And real estate is tangible, meaning it will always hold some value, even in downturns. But it does come with some baggage. There's usually some big upfront costs, down payments, closing costs, inspections costs, and it does have ongoing expenses like property taxes, insurance, repairs, tenants, and so forth. And it's not always liquid, meaning selling a property can take some time. It's a couple months, over a year.
So it sounds like there's some pros and cons for both.
Definitely some pros and cons. I definitely have some sores from doing the rentals in Tampa for sure.
Okay.
There's some pros and some cons.
And the same goes with the stock market.
Of course.
So it really depends on the person and their need.
Absolutely. So Dan, what does this look like side by side if we're really doing like a scenario looking at real estate versus the stock market?
Okay. Now let's look at real estate first. From a 30-year period, so 1995 to 2024, the national average of a home is $153,500. That'd be worth $557,000 today. Stocks, same 30-year period, $153,500 in the S&P 500 index would be worth $1.4 million today. With dividend reinvestment, that amount increases to almost $2.68 million. Advantage stocks by a landslide if we're only looking purely at returns. Note, real estate is often purchased as a growth and income investment, and this is not factoring rental income received, which can vary on many factors: location, region, tenants, so forth.
And remember, real estate offers leverage. That same house might have only required a $30,000 down payment in 1995, while your renters covered that mortgage. That leverage is what makes real estate so powerful for many investors. So Dan, are there any alternatives or like a third option here? If you kind of want to do stocks or bonds, or you kind of can't make your decision up on which way to go, is there an alternative option that most people would overlook, I guess?
Sure. REITs.
REITs.
Or real estate investment trusts. They let you buy into real estate through the stock market. I'm going to avoid getting into the differences between privately traded REITs and publicly traded REITs. But with REITs, you get exposure to property values and rental income, but with the liquidity of stocks, you can buy or sell instantly. Historically, REITs have sometimes outperformed stocks, depending on the time frame, of course. Now, if allocating 10% of the original $153,500 we spoke about earlier to REITs, the value after 30 years would be about $1.53 million and $2.98 million with dividends reinvested. That's a higher amount than no REITs at all. This is not factoring in volatility, though. The trade-off is that REITs can be sensitive to interest rates, and dividends are often taxed at higher rates.
Awesome. You just threw a lot at me, Dave. You threw a lot at me there. So can we get back to the question a little bit?
Okay.
In summary, what would be your suggestion as a senior financial advisor? Are we going stocks or are we going real estate?
It depends on your goals.
Okay.
If you want cash flow, leverage, and a tangible asset, real estate shines. If you want growth, liquidity, and low barriers to entry, stocks win. And if you want to blend, REITs are worth considering. But you don't have to pick one or the other. That's where the fourth option comes in. If you have enough wealth, I'd suggest investing in both the stock market and allocating a portion to real estate for income and diversification purposes. If you're an aggressive investor with an income focus, you can allocate up to 25% of your investable net worth to real estate. Now, most investors allocate between 5 to 10% to REITs. If you don't want to deal with the day-to-day management of real estate, REITs can be a good substitute.
The real key I keep hearing here is diversification, right? So the most profitable portfolios you would usually see have a good bit of diversification.
For sure.
Well, I hope that helps, Jason. If you want to talk to Dan or any of our senior advisors here at Security Financial Management, we'll leave a link in the description. And whether you're team house or team stock, the smartest move is to build a strategy that fits your personal financial goal. Remember, folks, the secret to wealth is not what you earn, it's what you keep. Happy days, everybody.
This podcast is for entertainment and educational purposes only and is not intended as personal financial advice. Before making any financial decision, please do your own research and consult a financial advisor as needed.